Right, hi, welcome to the business broadcast, and we have Richard Feekins, who is our head of tax, and he's going to discuss with us today about capital gains tax updates for residential properties. Now, it may be a quick one today. It's more of just a recap and clearing up any misconceptions that may be out there. So we will see how we get on, but if you have any questions, then please feel free to post those, and Richard will gladly be able to answer those during the course of the interview. Okay, over to you, Richard.
Well, hi everyone. I hope you've been enjoying this lovely weather we've been having, and I hope I'm not going to put a bit of a downer on it. But hey, this is a recap on a piece of legislation that was introduced back in April 2000. Requiring broadly people selling UK residential property to report that sale to HMRC within 60 days, and if there's any tax due, to pay the tax at the same time. So I just want to be quite specific on a number of points, because I think there are a few misconceptions flying around, perhaps around the internet and so on. The first thing is there is a requirement to file a capital gains tax return within 60 days of completion of a sale, only if it is a UK property, residential property, and it is not required if the property has been your only home throughout the period of ownership. It is required if there is either a capital gain or a loss arising in respect to the property, and the loss bit isn't often mentioned. There was a tax case fairly recently where, unfortunately, the taxpayer was charged penalties for late filing of a capital gains tax return on the sale of a property, and there was a loss, but they were still charged a penalty for late filing of the return. So it is important whether it's a gain or a loss, but if it's always been your home, that's fine. You don't need to do it. So I think it's worth covering off those points. Mm-hmm. I guess the next step then is to talk about, well, what would the capital gains tax be if you did have to pay capital gains tax? Well, the current rates are 18% if you're a basic rate taxpayer, 24% if you're a higher rate taxpayer. To the extent that any capital gain arising pushes you into the higher rate tax band, you're going to have a blended rate of 18 or 24%, depending on your other income for the year. There is still a small capital gains tax-free allowance available of £3,000 a year. Keeps going down every year. I'm sure it'll be removed entirely over the next couple of years, with the government trying to claw back as much tax as possible. But at the moment, that's where we are. Well, what next? So you're contemplating selling a property. And I think it's at the point that you're contemplating selling a property that you need to start gathering information, because this information will be needed for this capital gains tax return. The starting point would be the original completion statement when you bought the property, because that will show the price you paid for it, the stamp duty that you paid, which is an allowable cost. It'll show the legal fees that you paid, which again are an allowable cost. That's the starting point. The next then is to work out, well, did I live in the property at all? Because that will reduce your chargeable capital gain for that period only, calculated on a straight line basis over the entire ownership of the property. So if you lived in the property for even, let's say, 50 days, that will reduce your capital gains tax bill. It's calculated on a daily basis. I know it's a bit of a pain, but you need to get those dates right. when you actually occupied the property as your main home. So start gathering that information. The other slightly challenging part is that HMRC will allow costs relating to improvements to the property. Improvements commonly misconstrued. Then improvements would be a cost or an improvement that materially impacted the value of the property and continued to exist at the time that the property was sold. So let's give an example. If you added a loft conversion to the home, that clearly has an impact on the value of the property. Well, it may or may not do. It might be, but it's certainly an allowable cost. If you replaced windows in your property, that's considered a repair rather than an enhancement. So there is a very, very grey line between some of these. A common query we get is, well, I substantially repaired my drive, and it cost me thousands and thousands of pounds to do this. If the drive originally existed and you've then put in a cobbled drive, let's say, you haven't fundamentally changed the property.
No, it's more cosmetic, isn't it?
It's more cosmetic, or it's a repair. If, however, you've created a driveway and created parking for extra vehicles, and that still exists at the time that you sell the property, then that would be an allowable cost. So what I would say is, if you believe that you have any large significant cost during your period of ownership, let us have those, and we can explain why or why not they may be allowable.
It is. I assume things like, say, an upgrade to a heating system. So if you had one of these old back boilers, or there wasn't gas, it was electric heating or something like that, would that be considered?
Yeah, I mean, I would certainly say if you purchased the property with no central heating system, let's say, and it just had open fires, which is not that unusual. It does. We do still see these cases, and you put in central heating, then I would say that's an improvement. Whether it's enduring at the time of the sale is another matter, because it may have been replaced a couple of times during your ownership of the property. So the key point is that the expenditure must still be enduring at the time of the sale.
Right, fair enough.
If that original expenditure, the items that you originally spent it on, no longer exist, then it's not an allowable expense. For example, you could you may have bought a property and then erected a very nice garden shed in the back garden, and spent a garden office and spent quite a lot of money on it. If that doesn't still exist and enhance the value of the property at the date of sale, then it's not an allowable cost. Given the semi-temporary nature of some of these garden offices, that's quite possible. So there's no hard and fast rule. We have to look at the guidance. We have to look at, in some cases, case law to decide whether or not something is available. I wouldn't necessarily follow HMRC's guidance to the letter on this, because I'm not convinced they're always right. So, if it's quite a significant piece of expenditure, I think it's worth some analysis.
Okay, great.
Yeah. So, I mean, that's the first step, is to gather all the papers together regarding expenditure and so on. Now, at this point, you may well not have actually sold the property, so you won't have the final sale details, you won't have the final completion statement, but at least you're on the front foot.
Mhm.
bearing in mind we've only got 60 days to do this in. The really important thing to do, and we as agents cannot do this for you, is to register online for a capital gains tax account. Now, we can provide you with full instructions. It is very straightforward, but it is something we're not allowed to do for you. When you register for that account, you get a reference number. You don't actually report anything to HMRC at that point. We would look after all of that for you later on once the property is sold. If the property never sells, that's not an issue. That's not an issue at all. HMRC won't be coming after you saying, you've registered for a capital gains tax account. Can we have some details? It doesn't work like that.
Okay.
It's absolutely fine. Absolutely fine. One point that might be worth noting is that the capital gain must be reported within 60 days of the completion date.
Yes.
From a capital gains tax point of view, the time of the disposal is actually, in the vast majority of cases, the date that contracts are exchanged. So I'll come on to this further. There is some further reporting that you have to do, and that's an important point to note, because you may find that you are reporting a capital gain in one tax year, but not actually receiving the proceeds until the following tax year. There might be a very small period between the two, but these things do happen. That's pretty much it in terms of preparation. We'll just have a brief chat about non-UK residents and whether or not they need to report. The overriding rule is that a report must be made on a sale of a UK residential property. So if you're a non-resident, the rules apply in exactly the same way. A lot of non-residents are not familiar with these rules, and sometimes we just have to be alive to the fact that there is this lack of familiarity. It would be an alien concept for most non-UK residents. It was never widely publicised back in April 2000 when it was introduced, and there is still quite a lack of awareness around this, even though 5 years have gone by. The rules are slightly different for non-UK residents, though, in terms of how the gain is calculated. Back in 2015, for those tax nerds out there, the rules were changed to bring capital gains tax in for non-UK residents on the sale of UK property. Before that date, they didn't pay capital gains tax. If you were non-resident, you didn't pay capital gains tax on the sale of a UK property.
Okay.
So non-residents now are allowed to rebase the original cost of the property to the value as at April 2015. That's the default calculation. So that's the automatic calculation that would be applied. So in addition to all the other information I said that you'd need to gather, you also need to get a valuation as at April 2015 if you are a non-UK resident selling a UK property, if you happen to own the property before April 2015.
Okay.
Practically, that involves either obtaining valuations from perhaps a couple of agents, local estate agents, or simply going online, having a look at sold house prices and compiling a record of houses that have sold similar to yours, perhaps around that time. It really is as simple as that, and just keeping those records. In some situations, particularly if you occupied the property as your main home before 2015, ignoring the April 2015 date can give you a better capital gains tax result. And it's entirely at your option which calculation method you use. Although the default is to use the April 2015 valuation, you don't have to. And you can just calculate on the basis that UK residents do. In practice, this means as tax practitioners, we always prepare the two calculations just to make sure that you're going to get the best result. Every time.
Yeah.
Just to make absolutely sure, because it is an absolute your choice, absolutely. Have I covered that, Liz? Is that reasonably clear?
I think so. Yes. Unless anybody has any questions that they want to pose for any of those that may be listening. But I think, like you said, there's not a huge amount of updates in that area. So
no, I mean, the filing deadline for these returns has changed a couple of times over the years, but at the moment it is 60 days. That's not due to change. We know what the capital gains tax rates are currently. Oh, one thing I didn't mention were the situation with regard to furnished holiday lets.
Right, yes. For non-UK residents, or just in general?
Well, either UK residents or non-residents. So furnished holiday lets have always been treated a little bit differently to normal residential lets. And broadly, they've been treated as trading businesses, or, put it another way, commercial property. So furnished holiday lets did not fall within the definition of the sale of a UK residential property. So no capital gains tax 60-day return was required. However, the furnished holiday let regime has been abolished from April 2025, so that furnished holiday lets are treated exactly the same as any other residential UK property. So they're now within this reporting regime. I think I've probably covered the. I'll just reiterate that this return is required even if a loss is generated. I'll talk now a little bit about penalties for not filing. This is the nasty bit.
The bit that nobody likes.
The penalties for late filing these returns and late payment of the tax, if any is due, are exactly the same as the penalties for late filing a self-assessment tax return. So if the return is 30 days late, there's an automatic £100 penalty, irrespective of whether there was any tax due. If the return is 3 months late, there is an automatic penalty of £10 a day, up to a maximum of £900.
Okay. Gets expensive.
If it's 6 months late, it is 5% of the tax due, or £300 if greater. So what that means in practice is that if there is no tax due and it is filed 6 months or more late, you've got automatic penalties unrelated to any tax due of what, £1,300 automatically. If there is tax due, it's going to be more. So it is important. It's important not to miss the deadline, because even if you miss the deadline by 1 day, it's an automatic £100 penalty. That's not a great deal, but still it's irritating. But if it goes beyond that, then we do start getting into material penalties.
And I guess it's knowledge is key, isn't it? And because I think sometimes this has happened, or people have missed doing this just because they perhaps do not realised in certain circumstances that it was required.
So in the first, when this was introduced back in April 2000, in that following year, or as a result of that following year, there were a number of tribunal cases involving people appealing against the penalties on the basis that they just didn't know. The argument was that it wasn't properly publicised, they weren't informed. In the main, this related to non-UK residents, to be fair. The tribunal, in the majority of cases, allowed those appeals and said, no, we agree, you weren't informed, you couldn't have known, wasn't publicised, HMRC didn't advise you, despite knowing that you were letting a property, they didn't highlight this to you. So they got away with it, but we're 5 years into it now.
No excuses now.
I don't think that, even though I don't feel that there is a lot of awareness still, I don't think that argument will wash now with the tribunal. No. You can always try, but I think it's unlikely that you would advance a successful argument. Once you file this return, unfortunately, that's not the end of it. For those people who already file self-assessment tax returns every year, and there aren't really that many people who do. I think few million people file self-assessment tax returns. There really aren't that many, but those that do must then report that capital gain on their tax return.
Yes.
Including the tax that they have paid in respect of that return. Now, there's a really good reason for this. When the original 60-day return is prepared, of necessity, to calculate the capital gains tax due, you have to make an estimate of what your total income is going to be for the year to actually work out which tax band you're going to fall into.
Right.
And in many cases, that's not going to be spot on, because most self-assessment taxpayers do have slightly irregular income. They're not going to know exactly what their income is going to be for the year until after the end of the year has passed and they start preparing their tax return. So this is an opportunity to finalise the position and either reclaim capital gains tax has been overpaid or pay the extra tax that's due. As long as the original capital gains tax return was prepared correctly, there is no penalty for having slightly underpaid on the original 60-day return. That's fine. What is important is that it does go on to the end of year tax return. Interestingly, if you have overpaid capital gains tax on that 60-day return, it goes on to a different account at HMRC to your normal self-assessment account. It goes on to a capital gains tax account. And if you have overpaid, we have to write to HMRC and request that it is reallocated to your self-assessment account and then refunded from your self-assessment account. The offset does not happen automatically.
I'd imagine you've probably seen a few of those circumstances where that's happened.
which is frustrating. I had one case where the individual accidentally, so it was a jointly owned property, and the individual accidentally paid their share of the capital gains tax onto their husband's capital gains account. And it was around about £10,000. It did take us around about 9 months to get that refunded.
Wow.
So do have to be careful that you're making the payment on the right reference number, which of course we would give you, and just trying to avoid those things happening if at all possible.
Absolutely.
Yeah. For the vast majority of people that don't file a tax return or aren't required to file a tax return, there is no need to start filing a tax return as a result of doing this 60-day capital gains tax return. Instead, you use a HMRC online real-time capital gains service. Again, it's relatively straightforward. We can provide you with the guidance, but it is a very quick online reporting tool that just allows you to report the capital gain. If you don't like using online stuff, it's just not your thing, then you can just write to HMRC providing them with the details of the capital gain.
Okay. And they'll accept that.
So they will accept that. Just because you made a capital gain in the year, it does not automatically mean that you would have to file a self-assessment tax return. There are some circumstances where you might have to register, but it does not necessarily mean that you have to.
Okay, that's good to know.
Yeah. Well, I think that covers most queries.
Indeed. And you've done very well there and have taken the whole half an hour to go through all of that. Surprising.
I can waffle on about tax a bit.
So I think if anyone is having issues with surrounding this area or needs some extra guidance, or is you know that you're coming up to needing to file a capital gains return, then obviously do get in touch, and us at Orange will be able to help. Or if it's a complex one, then obviously we can get you in touch with Richard as well. So thank you for today.
Not a problem at all. I'm sorry if I've bored everybody senseless, but I just felt like this was a really important thing just to recap on, because there is still not this wide awareness around this.
Exactly. And as you said, that is not going to be an excuse going forward. So we need to get that awareness out there.
No.
Okay, perfect. Well, enjoy the rest of the lovely sunny day.
I hope everybody has a good weekend.
Yes.
And if you've got any queries, please get in touch.
Yeah, and we'll catch you next time. Thank you.
Great.